The Mcalvany Weekly Commentary, covering monetary, economic, and geopolitical news events.
We are talking about the stability of the global financial system. We are talking about confidence in the heart of money and credit. The thought that we can go out and endlessly inflate trillions of dollars of credit, and these are just basically electronic IOUs, that's all they are, journal entries, and pretend that that's real wealth. Again, history will not be kind.
Now here are Kevin Orrick and David Mcalvany.
Welcome to the Mcalvany Weekly Commentary. I'm Kevin Orrick along with David Mcalvany. Our guest today, Dave, Doug Noland. It's rare for us to have a guest on 2 weeks in a row, and this is week one of a 2-week show.
I have a confession, and that is that I do keep secrets. This particular secret is Doug Noland. We don't talk about the Credit Bubble Bulletin all that often because the resource is so valuable to me. I almost treat it like my precious little source of data analysis.
So when people say, so Dave, you came up with that yourself, you don't want to have to tell the truth.
If they ask directly, I'll be more than happy to. And I've given him credit saying Doug Noland says this and such without connecting all the dots back to the Credit Bubble Bulletin.
Well,
but you know what?
Last week.
The Credit Bubble Bulletin comes from a certain background. Doug began as a CPA and treasury analyst and then went to work in the hedge fund industry for about 9 years with Gordon Ringon in San Francisco, with Bill Fleckenstein, did some writing with someone who's very well known, I think, in the credit space, and that is Dr. Rishabashar. And then spent 16 years with David Tice, where Doug managed the Prudent Bear funds, both in Dallas and then ultimately with Federated in Pennsylvania. That was then, this is now. Shorting has been his expertise going back to the 9-year experience with Gordon Ringon in the hedge fund space. So he thinks like a CPA, he thinks like a treasury analyst, he thinks very analytically about all the things that serve as signs and indicators of a change in the marketplace, which is relevant to a trigger point when he should be short the market.
Well, and I think we probably ought to bring up for the listener who's not familiar with shorting the market. That's just a way of saying, look, I think the market's going to go down. I want to make money on the downside, not necessarily on the upside. And this has been an area of specialty of Doug Noland's virtually his entire career.
It means that you have a sensitivity to fragilities. It means that you have an eye for dislocation. It means that you have a nose for things getting out of line relative to history and relative to what an economy can sustain. So, yeah, it's a valuable resource for me, the Credit Bubble Bulletin. It's worth reading. I used to go to the Prudent Bear website every day. And I don't go to the Prudent Bear website at all anymore because
Doug's not there.
Doug Noland took the value of going there every day with him because he was the value, in my humble opinion. You know, just as a bit of background, maybe you could share with us. You've been doing the Credit Bubble Bulletin since the turn of the century?
1999.
1999. Okay, so just before. Tell us a little bit about your theoretical framework. Explore, if you would, the lens through which you see things.
Sure. And thanks a lot for having me, David. It's a treat to be here with you. My framework goes back to the early 1990s, and I was working for a hedge fund out in San Francisco, a bearish hedge fund manager. We were professional bears. And my first year in the industry was 1990. We had just phenomenal success. We were the geniuses. And we had it all figured out. The economy was going into recession, bear market. We were going to be rich. And then you had 1991. All of a sudden, the markets rallied. And I started to try to understand how an impaired banking system kind of morphed into this new age financial system, driving not only the prosperity in the 1990s, but this phenomenal bull market. So for me, it was an obsession. It really was an obsession to try to understand what was going on in finance, what was changing to fuel the boom. And my attention went to asset-backed securities, mortgage-backed securities, Fannie and Freddie, and we were totally changing finance. We were moving away from the traditional banking system and bank lending driving finance to Wall Street finance. And I just thought that this was an incredibly interesting period of time, interesting development in the markets. And then we started to have this wild financial volatility. We had the bond market, bear market in 1994, Mexican collapse, Southeast Asia. And then in 1998, you had long-term capital management and the collapse in Russia. And these were spectacular booms and busts. And I was convinced that this new finance was fueling these booms and busts, yet there was very little talk about any of this. The talk was still that only banks create money, that banks drive credit, that the Federal Reserve controls all of this. And I was saying, no, it's completely different than that. So that's why I started writing my blog. I thought there was just this historic evolution in finance, this transformation that was getting very little attention. I started my blog. I was trying to title it, and I decided, okay, the Credit Bubble Bulletin, and I'm just going to chronicle this. And I thought maybe the bubble would be in the title for a year or two. In 1999, I was convinced the bubble was about ready to burst. That bubble did burst. But then we had a new bubble. In 2002, I started warning about the mortgage finance bubble, but never did I imagine we'd be in 2016 and I would still have the bubble in the title of my blog and I would still be calling another bubble.
And Janet Yellen, as recently as April of this year, has said that our economy is on a solid course. It is not a bubble economy. And so clearly there is a contrast between the glasses through which she sees the world and the glasses through which you see the world.
Absolutely. And I remember the same comments in the 1990s, the new paradigm. This was an age of financial stability. We certainly heard a lot of that during the mortgage finance bubble period, that policymakers were enlightened and that they'd created a more stable environment. I just look at the situation as we have this huge bubble in securities, the biggest bubble ever. And it only appears stable because the central banks now are completely backstopping it with zero and negative interest rates, with QE, which is essentially money printing. You know, we have over 2 trillion annualized QE in the world today. So to me, it's a very unstable system that the central banks so far have been able to sustain. And they're only sustaining it by making the bubble larger.
Well, that's a reminder that there is a huge presumption on their part of control. And what would you say that they can control versus what they think they can control?
Well, this gets back even to the 1990s. And in the early 1990s, the banking system was impaired. And, Citigroup, there was talk of it being insolvent. And part of what happened is we had this non-bank credit growth, Fannie and Freddie and mortgage-backed securities, etc. And the Greenspan Federal Reserve encouraged this growth, because the banking system was impaired. And this securitized finance kind of got away from them. So they can only control it by incentivizing the hedge funds to leverage, to incentivizing money to continue to flow in today to bond funds, even though the yields are so low. So they've been able to control market expectations, and how they do that. And we saw that in 2012. It was when Draghi came forward and said that the ECB would do whatever it takes. But actually, he wasn't speaking for the ECB. He was speaking for central bankers all over the world. And now we've seen the Bank of Japan, we've seen the Bank of England, we've seen the Chinese Central Bank, we've seen the Fed basically say, we will do whatever it takes to ensure there's not a crisis, to ensure there's not a bear market, to ensure there's not a recession. And so far, the participants in the market believe that's true and believe that QE goes on indefinitely to levitate the markets.
Is it the understanding of your average market practitioner that there's no negative consequences from that, or do they not care because the future is the future and the present is the present, and it's only worth trading dollars in present terms? Let the future sort itself out.
Yeah, I think it's short-termism everywhere. I think most people in the market know this is unhealthy, an unhealthy dynamic with the central banks, but the focus is performance that month, performance that quarter. In the financial markets, if you perform poorly you don't have much of a career. So we see that for investors, portfolio managers, financial advisors, hedge fund managers. Everyone has to play the game today, or they have to find something else to do with their careers. It's a very unhealthy dynamic, but that's kind of how it's evolved.
It seems odd to me. I mean, we're now 2016. We had Ben Bernanke talking about an exit strategy for the Fed from their extraordinary monetary policy measures back in 2011. And kind of an add-on to that last question, why don't market participants seem to care about the reliance on monetary policy experimentation in order to maintain the status quo? Are you boiling it down to self-interest? Is it that, there is an outsized faith in the Fed that if they've done this, clearly they'll do even more if called upon? I don't understand the rationale because it seems like it's one desperate measure to the next, and market participants aren't seeing them as desperate measures at all.
Yeah, it's all become normal, I guess. Yeah, back in 2011, the Fed made public a very detailed exit strategy. And I think at the time they planned on winding down their balance sheet growth, normalizing interest rates. But at the point, and I archive all my old articles, and I titled one of my bulletins, No Exit, because I thought it would be impossible for them to shrink their balance sheet that had grown to $2.1 trillion. But I'll tell you, in 2011, when I wrote No Exit, I did not imagine the balance sheet, instead of going back below $1 trillion, was on its way to $4.5 trillion. If you stand back and look at what's happened, it's been unimaginable that these central banks have inflated credit this way. And we're to the point now where the bubble is so big, and at least the sophisticated operators, a lot of the hedge fund managers, they know the bubble's so big. They know central banks are trapped and they have no choice but to backstop the markets and to continue to inflate securities prices. So that's enough to keep players playing the game. There can be a lot of money to be made at the end of a speculative bubble, and we can think back to 1999. And that's the way these bubbles work. It gets crazy at the end. People lose a lot of money, but in the meantime, some people can do pretty well. And if you don't participate, you're in trouble.
Well, it's like the alchemists of old, which dreamed of creating gold or money from dirt. And you've got modern central bankers who've done one better. They can take modern money or credit. They can create it from nothing. It doesn't even require the dirt. There's a certain set of ideas that are popular among central bankers. I spoke to one British central banker 6 months ago who casually said that, look, you can expand credit, you can expand your balance sheet indefinitely. It's not a precursor to inflation because it'll be sterilized. So this idea that somehow what they're doing does not have a consequence because they have a mechanism or a tool to take away the bad consequences. Is it realistic?
I think future historians will be unkind. It'll be very difficult to comprehend how this happened. As I said, in 2012, things turned, well, let's just say crazy, where whatever it takes central banking completely took over, global markets. For me, and I mentioned, I thought the tech bubble burst back in 2000, 2001. In 2002, I had to change my tune, and that's when I began warning of the mortgage finance bubble. Why? Because the Federal Reserve specifically was targeting mortgage credit to reflate the whole economy after the bursting of the tech bubble. And I knew this was going to lead to, pricing distortions in mortgage credit, housing inflation, and self-reinforcing speculation in the markets, especially in mortgage credit. When that bubble burst in 2008, I thought it was over. Well, in 2009, I had to change my tune again. I think it was April 2009. That's when I first started warning about the potential emergence of what I called the global government finance bubble, which to me was very troubling because mortgage credit was dangerous to distort mortgage credit the way it was done with all the government backstops. What central bankers were doing, the Bernanke doctrine basically wanted to inflate security market prices, wanted to inflate central bank credit, wanted to inflate government debt. So this bubble has gone not only global, because we've exported these types of excesses, it's gone to the heart of money and credit. What we've been doing is inflating central bank credit, government debt, the heart of the credit system, the heart of money. what people in the past have trusted. And for me, that's the most dangerous type of a bubble. If you have a bubble, let's say in junk debt, that can be problematic. You can have a boom there. But you get to a point where that credit's risky. The market knows it's risky. There's a limited demand for that type of credit. That bubble will not turn systemic. The mortgage finance bubble was much closer to money-like. People trusted the GSE credit. They trusted mortgage-backed securities. They trusted government would back this debt. So that bubble ran for years, went to incredible excess, became very systemic, affecting much more of the whole economy. The global government finance bubble, as I said, has gone to the heart of money and credit. It's gone global. And I fear when this bubble bursts, the consequences are immense. They're enormous, profound, because if people don't trust central bank credit, don't trust government debt, then they're not going to trust finance generally. That's the type of credit crisis that could be global. The excesses in China have been extraordinary. So this bubble is much more troubling to me. I was very nervous in 2007, much more nervous today. And that any central banker can talk about this type of credit expansion not having consequences is really hard for me to listen to believe.
So we're talking about the global government finance bubble, and it would appear that bubble dynamics don't disappear. With intervention, they simply move up the food chain. When you've gotten to the government finance bubble, what comes after the government finance bubble? Are we at the top of the food chain?
Yes, that is my fear. And there's a lot of interesting theory with bubbles. And they can go on for a long time. And that's where we are today. The bubble's been going on for 25, 30 years. So, of course, after that long of a period, it seems like it can go on forever. But when you get to the end of the line, when you're inflating government debt and central bank credit, again, not only when that bubble bursts, is there an inevitable crisis of confidence? How do you get the next bubble? Because each bubble to reflate, the collapse of the old bubble has to be bigger. I don't know how if the next bubble is bigger. Not only have we gone to the heart of money and credit, we're going to probably have $3 trillion worth of credit growth in China this year. The fact that the global bubble went to China and the emerging markets, they were the locomotive, the global locomotive for the recovery after the collapse of the mortgage finance bubble back in 2002, 2008, 2009. So it's very difficult for me to see where the inflationary fuel can come for the next bubble, which leads me to believe we'll have QE almost indefinitely until the markets just lose faith in that type of credit.
It's almost like financial rules don't exist. You look at the bubble dynamic in government finance, and the game changer in the last couple of years has been seeing central banks take zero rates, which, being at the zero bound was pretty impressive. And then all of a sudden we went negative. And now you've got the Financial Times reporting over $13 trillion in negative yielding paper. And again, it's like financial rules don't exist. If you think you understand the limits of a bubble, then all of a sudden the rules are changed. Rates don't have to be positive. They can be negative. Now the question might be, well, how negative can they go? And that is a question I have for you. How negative can rates go before you begin to distort investment perceptions of the paper they're investing in and change their behaviors in terms of why they would want to own that paper anyways?
Yeah, another excellent question, David. Part of this new finance that, I began chronicling back in the late 1990s, it was asset-based finance. This is new credit going specifically into the asset markets, mortgages, stocks, bonds. That's very seductive credit because when the mortgage goes into those inflating assets, the higher asset prices leads to more credit growth. The more credit growth leads to higher asset prices, more wealth creation. The economy grows, and it almost seems miraculous. Actually, it does seem miraculous. But this type of credit's very unstable. We saw how this works with tech stocks. It doesn't work well in reverse. We saw how it worked in 2008, 2009, when all of a sudden you have a contraction in credit, you have falling asset prices, and it's self-feeding on the downside. How is that rectified? Zero rates that have turned negative. The QE going into the market directly and purchasing bonds. It started off in sovereign bonds. It's gone to corporate bonds. It's gone into equities, at least in Japan. And these negative yields really are just an inflated price for all of these bonds. And that keeps this credit game going. The problem is, if you have a reversal in the bond market, and I think there's an enormous amount of leverage that's built up in the bond market, then you have an immediate problem. So right now that central bankers are trying to eliminate the possibility of higher yields, lower bond prices, and this de-risking, deleveraging dynamic. But all this has done is created a much larger speculative bubble. And now I think we're seeing enormous distortions that these negative interest rates are causing. Distortions in the derivatives markets. Keep in mind that interest rate derivatives are the largest derivative market in the world. You literally have hundreds of trillions of dollars in interest rate derivatives. And I think there's a huge underlying dislocation in that market. I think it's caused a lot of leverage to be created, a lot of liquidity being created in the derivative markets that's now fed into the emerging markets. It's fed into the corporate debt market. It's fed into equities. So these negative interest rates are causing huge distortions, a dislocation in the government debt markets, derivative markets, and just a bigger securities bubble that's gone global. It's gone into basically all asset classes and is now, deeply systemic, unlike any bubble we've had in history.
Well, and we see this change in investor expectation as the bedrock of finances has shifted. You have people buying stocks for yield, not for capital gains. You have people buying bonds for capital gains, not for yield, and a confusion of priorities in terms of what goes into a portfolio and for what purpose. They've had to change their expectations because of central bank tinkering with the economy. You look at the Chinese, and you've seen massive interventions in the marketplace. You have the biggest sectors in the economy controlled by the government. The question I have is, if you change the nature of the economy to a Chinese version of capitalism, with command and control dynamics as dominant features, can you manage the consequences of credit excess? I mean, is there an end to it? When you control the media, when you control the SOEs through the state-owned enterprises, you can also sort of create new special purpose vehicles and take all the garbage that is collecting in terms of bad debt, bad promises, bad businesses, just wrap it all up into, a toxic waste dump. We did a little bit of that with Maiden Lane 1 and 2, but the Chinese seem to be experimenting with it on an even grander scale. Who's to say that the new version of capitalism doesn't have these command and control dynamics, and we just got to get used to the new world?
I'll say right up front, I hope I'm way too dire. I hope this analysis proves laughable. I would love to be wrong on this. As an analyst of money and credit, macro analyst, I look at what's unfolded in China, and I've been following this closely now, documenting this for years. I am in awe of what's unfolded there. The Chinese used to speak not that many years ago. They really studied the Japanese experience and the Japanese bubble. And they used to comment publicly that they had learned a lot of valuable lessons from Japan, that they would not repeat those mistakes. Well, their bubble got completely away from them. At the end of the day, they learned nothing. The excesses started to grow, and then, they pushed the panic button back in 2008, 2009, had a massive inflation, $600 billion stimulus, I believe, and they haven't been able to turn back. Several times they've recognized the excesses in real estate and credit. They've gone in to carefully try to rein in excess, and the longer a bubble unfolds and inflates, the more aggressive the reining in that's necessary to end the bubble. They were not willing to take hard action, and it got completely away from them. And there's some belief that they can manage their situation. They can recapitalize their banks. They can take the bad loans off the balance sheets of the banks, set up these new entities. There's a massive growth in their off-balance sheet wealth management vehicles. Well, at the bottom line in a credit bubble, China needs $3 trillion of credit this year to sustain this distorted economy, to sustain inflated asset prices, to sustain the bubble. That $3 trillion of credit this year is going to be very, very unsound. You cannot inflate your way out of a bubble like this. And I would argue, I call it the terminal phase of excess. At the end of the bubble, and that's when policymakers get cautious because they don't want to pierce the bubble because the risks are more obvious. That's exactly when you need aggressive intervention, because your systemic risk grows exponentially because you're growing credit rapidly and the quality of that credit is deteriorating rapidly. So it's a very dangerous situation where you can really destroy your credit system in a relatively short period of time. In the 1980s, Japan basically destroyed their credit system in about 3.5 years after doing miraculous things for a few decades. They destroyed their system in a few years. We saw $1 trillion worth of subprime mortgage CDOs in 2006, which almost destroyed the financial system. So I do not believe at all that this is under control in China, that they have a model that they can manage these types of risks. In fact, this is the most dangerous bubble in history unfolding in China right now.
Is there anything to suggest that at this stage of the game, the stakes are so high and politicians have not been willing to make the hard fiscal choices along the way and have allowed for excesses to increase and for monetary policy to be used as a primary tool to try to meet the challenges of the day? Is there something from history that suggests that at this point we see political solutions, not financial and economic solutions? Let's say designating a loss. You're the chosen loser today.
Yes. And I was going to reference ex-Dallas Fed President Richard Fisher used to talk about the law of holes. And if you find yourself in the hole, the first thing you do is you stop digging. For me, a solution right now is to try to end the impairment of money and credit, try to get the governments, the central banks out of the markets to quit distorting the debt markets and equity markets. And that would cause a significant dislocation in the markets and in the economy. But we're on a path right now where we're going to have a crisis of confidence in all of credit. So you need dramatic steps right now to try to at least get us on a more sustainable path. I certainly don't see that coming from politicians. And this is an argument that goes back a couple of 100 years as far as, do you want discretionary central banking or do you want rules? And the debate early on was the problem with discretionary central banking, monetary management, is that one mistake will inevitably lead to more mistakes because there's not an acceptance of previous mistakes, and central bankers will try to inflate their way out of the problem, which only compounds the problem. And that's where we are today, where this is just compounding problems that have been developing now for really decades.
So if you find yourself in a hole, stop digging. Fisher's law of holes. I like it. Well, I tell you, this is in contrast. The opinion is certainly in contrast to a discussion we had with Richard Duncan a few weeks back, in which he would say, we need an expansion of credit to the tune of about 2.2% net of inflation in order to avoid recession. And if we don't continue to feed the credit machine, you mentioned the Chinese need $3 trillion in new credit to sustain the bubble. Well, that's more of a global issue. Looking at just a domestic problem here in the United States, we need to expand credit, whether it's private, corporate, or governmental, to these numbers, or we see recession. Fisher would say, listen, if you're in a hole, stop digging. And you would say, look, you've got to wrap your arms around the problem, not keep on adding to it and pretending it doesn't exist.
Right. And there needs to be some discussion of what the stakes are. I mean, we are talking about the stability of the global financial system. We are talking about confidence in the heart of money and credit. That needs to be protected. The thought that we can go out and endlessly inflate trillions of dollars of credit, and these are just basically electronic IOUs. That's all they are. They're just journal entries. And pretend that that's real wealth. Again, history will not be kind. You have to wean your system off of this type of credit addiction, this dependency. To throw out a couple of numbers, back in the 1990s, And there were excesses in the 90s, but the U.S. economy depended on a $600 to $700 billion of non-financial credit growth. We needed that amount of new financial claims to drive that economic structure. By the time you get to 2006, even 2005, that credit dependency is up to almost $2.5 trillion. Why? Because you inflated asset prices, you inflated incomes, you inflated corporate profits, you distorted your whole economy to where you have to keep feeding it with new financial claims. China, as we mentioned, they're up to $3 trillion. The problem is you cannot continue to inflate financial claims in that environment and expect those financial claims to be sound in the marketplace inevitably. That's what we have to start thinking about and protecting, and immediately reduce the amount of credit in the economy, reduce the distortions. There is no alternative than a really difficult recession, unfortunately, because the economy will not respond well to less credit here, China, or elsewhere. But again, if we want to get on to a sustainable course going forward, that's how it has to begin, is to reduce the credit addiction. Because again, that is the financial inflation, the credit inflation that will come back to haunt the system when people do not trust that credit.
So what you're really talking about is a confidence game. And there's been a tremendous amount of confidence that has been assumed in the world of money and credit. And that confidence to some degree has been abused following the end of the Bretton Woods Agreement going back to 1971, where for the first time in world history, we had a money system which was devoid of any real tangible anchor. And now you have an entirely free-floating money system. It's allowed for the expansion of credit and credit as money to grow exponentially without bounds. You layer into that what you described earlier as sort of a morphing of the markets in the 90s, moving away from bank finance to Wall Street finance. And it seems like we're accommodating and accommodating and accommodating and accommodating these unhealthy changes. But on the one hand, it's given us more economic activity, more economic growth, but it has come at a cost, a future cost, because that's what debt is, right? Something that you have to pay in the future. We've had a certain economic advantage in the present, but there is a price to pay for that. That is the stock of debt, which has to ultimately be paid back.
That's right.
Now, you've got the assumption by central bankers and governments that it doesn't matter how much debt you go into because you can always inflate it away. So you have at odds what is in the interest of the people and the interest of central bankers, which is we would prefer stable prices, not inflated prices. And yet they know that they can abuse this system of finance, creating excess credit, not worried because eventually they'll inflate it away. And now they are in this strange scenario where attempting to create inflation, they're unable to. What do you think keeps central bankers up at night as they try to create inflation and haven't been able to thus far?
Yeah, I think they stay up late at night because they know they're in an experiment. There's been nothing like this in the past, and it has not worked as they expected. Again, they were talking exit strategy in 2011, and here we are today.
Well, Dave, as we said in the beginning of the show, we're going to have a second show where we're probably going to be a little bit more recommendation-oriented. Listeners oftentimes say, okay, well, that's fine. I understand the economy's in wicked bad shape, but what do I do now? And Doug has always been able to come up with some overall macroeconomic solutions to a portfolio.
Well, that's right. We'll continue the conversation from this week and hopefully explore some of the practical elements of investing in this environment.
You've been listening to the Mcalvany Weekly Commentary. I'm Kevin Orrick along with David Mcalvany and our guest today, Doug Noland. You can find us at Mcalvany.com, McAlvany.com, or give us a call at 800-525-9556.
This has been the Mcalvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the Mcalvany Weekly Commentary.